high. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show, where we bring you the story behind the latest developments in the banking space. It is the 5th of October and I am Ruchika Chitravanshi. In today's episode, our cover story focuses on what to expect from the upcoming monetary policy of the RBI. In Banker's View, we have with us Vikas Goyel, MD and CEO of PNB Gilts. In Banking for You, we will tell you all about the neutral stance of RBI in the context of the monetary policy. Continuing with this theme, our consulting editor, Tamal Bandhopadhyay, will discuss the monetary policy. At the end of the show, we will tell you the results of the last week's poll and the question for this week. The Reserve Bank of India's Monetary Policy Committee, or the MPC, met on October 4th amid growing economic challenges. There are concerns that consumption demand may be at risk. The uneven monsoon could have an impact on kharif crops, and global crude oil prices have been rising. Against this backdrop, when the central bank announces the review of the policy on October 6th, will it keep the repo rate unchanged for the fourth consecutive time? And will it maintain its withdrawal of accommodation stance? Anjali Kumari and Bhaskar Kumar find out what the experts think.
Experts think that the 6-member MPC of the RBI will most probably maintain a status quo during the October 6th policy review. The MPC had increased the repo rate by 250 basis points to 6.5% between May 2022 and February 2023, after which it hit a pause in the April review of the monetary policy. Experts told Business Standard that the RBI MPC was likely to maintain a status quo because food inflation had subsided. They added that while vegetable prices were under control, crude oil prices could become an issue going forward.
We expect RBI to hold the rates steady and I think hold them higher for longer. Already we are seeing there is a tilt towards tightening liquidity. So that's the reason for that is we got a shock from food inflation, particularly vegetables, which is correcting. But now I think the fuel prices are becoming a worry. So central bank will not lower its guard and keep the rates where they are, and maybe for longer now than we earlier expected.
All 10 respondents in a Business Standard poll also said that the MPC was expected to maintain a status quo in the October 6th policy review. Ahead of the MPC meet, consumer price index-based inflation eased to 6.83% in August from a 15-month high of 7.44% in July. This drop came mainly on the back of a decline in the rate of the rise in vegetable prices. Only 3 respondents expected the RBI to marginally raise the FY24 inflation projection. In the August policy, CPI-based inflation for FY24 was projected at 5.4%. On the other hand, none of the respondents expected the RBI to revise its FY24 GDP growth forecast from 6.5%. And except PNB Gilts, all the respondents expected the committee members to maintain the withdrawal of accommodation stance. They expect the RBI to do so even as net liquidity in the banking system remains in deficit.
I think they'll continue with the stance of withdrawal of accommodation because I think, as I said, the inflation is still a worry. I mean, it's come down a bit, but I think the risk is still there because of the monsoons, because of the El Nino, and now also because of the fuel.
PNB Gilts Managing Director and CEO Vikas Goyel said the stance would change to neutral because inflation trends were going to come down in all probability. Goel also said that some forward forecasts on growth was showing cracks despite the numbers being good at present. Thus, he added a stance change was required to create a path towards an eventual rate cut. Overall, the thinking among experts is that the central bank will look to keep liquidity at a level while also keeping in mind the requirements of the festival season. Above all, the RBI will stay vigilant.
I think the key question is how far the oil will rise and how long will it stay there. I think because the rising oil prices create risk for inflation, they create for risk for current account deficit, and they also create a downside to GDP growth. So I think it's time for vigil, not for alarm, I would say.
In conclusion, the expectation among the respondents to the Business Standard poll is that the tone of the policy will be hawkish even if interest rates are kept unchanged.
So, status quo seems to be the overall expectation from the October 6th Monetary Policy Review. Moving on, in an exclusive interview with Business Standard's Manojit Saha, Vikas Goyel, MD and CEO of PNB Gilts, shares his perspective on the upcoming monetary policy review of the RBI, green bonds, and the kind of inflows he expects in the run-up to the index inclusion.
PNB Gilts is the only listed primary dealer in the country. Vikas Goyel, MD and CEO of PNB Gilts, is with us today. There are a range of issues that we will discuss related to financial markets, from index inclusion to green bonds and the monetary policy review of RBI, which will be announced on Friday. Mr. Goyel, welcome to the show.
Thank you, Manojit. Thank you for having me on the show.
Thank you, sir. So let me start with the monetary policy. While it is almost certain that there will be a status quo on the policy rates, but do you think time has come to change the stance to neutral?
Is that high time Reserve Bank became data dependent and established a glide path. So going to neutral does not mean that you are going to cut rates. It just means that you are data dependent, and depending upon data, you can either hike or drop rates. So right now the stance is only of hiking. While yes, last couple of months, July and August inflation numbers were high because of food prices more or less, and somewhat energy. Basically, the volatile component core has been steady to coming down, and it's in not in a comfortable zone, but still it is trending down. It has been sticky at 5, and it has been trending down now. So, given that core is trending down a bit, and the volatile portion is what was contributing to high headline, and that hopefully will now no longer be an issue. At least the food part, monsoon being more or less normal. So the food part of it, the food inflation part of it, I think is maybe addressed or mitigated. Energy obviously is another question altogether. With OPEC now, given that prices again, though they were rising and they have come off in the last couple of days, so how will OPEC react? Will they continue beyond December their production cuts? That is yet to be seen, but I think that energy prices play a limited role, given that in the inflation number, given that there is no change in prices at the pump level, local prices. So overall, I think inflation now and the forecast now for this month for September print, I think is in a comfortable zone, anywhere between 480 to 525, 540. So maybe about 5 quarter. So while still above the target of 4, it is within the range of 2 to 6. And it looks like the high prints are behind us, and the prints will come within the range. Given this background, I think a glide path needs to be established. Therefore, a change in stance may be warranted in this case.
So, do you think a government should put a mandate there could be some steps that should be taken to popularize the green bonds?
Well, I'm not a proponent of a directing the market. Let the market decide uh, where the correct prices should be. Yes, some incentives can be given, maybe SLR multiplier or a LCR multiplier. Alternatively, you can again penalize the savers, and a portion of category 1 PF investment can be dedicated only to green bonds. Then automatically you will get a premium, but that is penalizing the savers. Somewhere, it has to come from somewhere, right? A lower rate has to come from somewhere, right? So I think most probably an economic incentive rather than direction would be a better way to go to get a premium.
And finally, sir, on the index inclusion, what kind of inflows do you expect in the run-up to the actual inclusion when it happens?
Well, that's a good question. I mean, there's a crowding in effect. Obviously, the passive guys will come in starting June when 1% kicks in, 1% a month kicks in June of 24. Before that, obviously, there'll be some active guys front running the passive guys. So I do see some flows, but generally speaking, Indian government bonds market have not been of great interest to foreign investors because yields are risk-adjusted yields. Let's put it this way, are relatively low, and on a fully hedged basis, it has never made sense. I still see, yes, there will be some front running which will happen, but I suspect it will be modest. And having said that, anyways, right now we are in a sweet spot, like you mentioned earlier, when we discussed earlier, that H2 borrowing program anyways is limited, supply is limited, and we are at a cusp of, inflation trending down. Hopefully, some point of time in this quarter, if liquidity will be reinstated and we will go back into the range of fixings, will go back near about the repo rate. Right. So that will give the impetus to the market to anyways, buy a lot of stuff, lot of this supply. There's a lot of discussion about passive guys. So generally, the funds which track the index is about, currently is 210 billion. Our weight of 10% is 21 billion in this index, right? So what it depends upon, obviously, what will be the AUM come June 24. So that can be more or less. Right. So roughly anywhere between 20 and higher is the number. And now there is a little discussion which is happening that some of the funds tracking are not passive, they are active trackers. So then the number can vary up or down. So I see a number anywhere between 18 to 20 to 23, depending upon what the AUM is come June 24.
On that note, Mr. Goel, thank you so much for speaking to Business Standard. It was a pleasure talking to you.
Thank you very much for having me on the show. It was interesting. Good luck and thank you.
In his last MPC announcement in August, RBI Governor Shaktikanta Das said they will continue with its stance of withdrawal of accommodation. The 6-member rate-setting committee had changed its official stance from accommodative to withdrawal of accommodation in June last year. Some experts believe the RBI may change its stance to neutral this time. What is this stance? Raghav Agarwal explains.
The Reserve Bank of India is all set to announce its Monetary Policy Committee decisions on key interest rates in the economy on Friday, October 6th. Some experts contend the RBI may change its stance to neutral this time. But what is this stance? With a neutral stance, the central bank signals that it places an equal priority on inflation as well as growth. The MPC can go for either rate hikes or rate cuts to suit the needs. The decision is dependent upon incoming macroeconomic data. Inflation in India has continued to cool down since March this year. In March, it fell below the upper limit of 6%. In April, it cooled down to below 5%. In May, the retail inflation fell to 4.31%. although the inflation in July and August was outside RBI's upper tolerance limit of 6%. Experts have said that RBI must change its stance to neutral. So far, however, MPC has decided to go for the withdrawal of accommodation. There are several other stances of the MPC. Let's go through them one by one. What is the accommodative stance? If the central bank decides to keep the stance as accommodative, it is prepared to increase the money supply to boost growth and reduce unemployment in the economy. The central bank usually cuts the key interest rates to increase the money supply. This stance is usually taken during and after a crisis to support the economy. In the 2 years of the COVID-19 pandemic between 2020 and 2022, the RBI kept an accommodative stance. Moreover, an accommodative stance is taken when inflation is not the immediate concern in the economy. Low interest rates encourage businesses and investors to take risks and invest more. This policy is withdrawn when inflation comes into focus and starts hurting the consumption in the economy. Last year, the RBI started hiking the repo rate in May after inflation soared past its upper tolerance limit of 6% in March. Currently, RBI MPC has maintained its stance. What is a hawkish stance? Another type of stance is when the MPC decides to be hawkish. Under this, the main aim of the central bank is to control inflation. If the rate setting committee goes for this stance, they are willing to hike interest rates to curb the high prices, even if it hurts the growth rates. Under the hawkish stance, the central bank tightens the monetary policy. Generally, this is done when inflation is too high and needs to be brought down quickly. What is calibrated tightening? The central banks have widely used the term calibrated tightening in their monetary policy announcements, especially since the start of 2022. Under this stance, a rate cut is off the table and the rate hikes take place in a calculated manner. The central bank may not go for a rate hike in every policy announcement, but its stance remains titled towards a rate hike. In this case, rate hikes can occur even outside the usual policy meetings if the situation warrants. Generally, this stance is taken when inflation is high but not too high, and the central bank does not want to hurt the economy's growth rate.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So if RBI places an equal priority on inflation and growth, we know that it's neutral stance. RBI's monetary policy review is coming tomorrow in the backdrop of the upcoming festival season, followed by the elections both at the state and centre. This would mean more cash with public or higher liquidity. What does all this mean for the interest rate hike and the stance of our central bank? Our consulting editor, Tamal Bandyopadhyay, gives us his insights in our expert take. Hi, Tamal. Welcome to the Business Standard Banking Show. Tomorrow is RBI's monetary policy, and in your report, in your column this week, you've said that you expect status quo on rate. Can you tell us broadly what are the reasons why you expect a status quo, given that inflation is actually still a concern?
So inflation, yes, globally also inflation is a threat. On top of that, we have seen what's happening in on the oil front. It's actually higher than what RBI estimated. RBI estimated 85. It's now 90. It's 10-month high. So on the inflation side, are we extremely well off? Certainly not. But as I said, RBI, I think, is confident that it will come down slowly, even though it is higher than Reserve Bank of India estimate. I mean, the target, which is 4% plus minus 2 percentage point. So keeping all that in mind and supporting growth and making the economy work in the right way, I would like to believe that Reserve Bank of India will keep the rate unchanged. And one more interesting fact is this: the core inflation, what you are talking about. It is pretty good. I mean, and it's been falling, and I think the last core inflation was 4.9, close to 5%. Of course, the oil will have an impact on retail, including core inflation, which is a non-oil, non-food inflation. But overall, I feel that the worst is behind us as far as inflation is concerned. RBI will not let its guard down. RBI will continuously be watching with a lot of caution. So it will be a hawkish policy probably, but on the rate front, I would like to believe it remains where it was since February. It was the last time the rate hike was in February. Between last May 2022 and February 2023, the rate had been hiked from 4% to 6.5%.
Now, on the stance, you have said, will it change the stance from withdrawal of accommodation? You've said no. There are some people who have said that there may be a change in stance. Why do you think that there will not be a change in stance?
No, I would like to believe the stance will remain the same, which is withdrawal of accommodation. Now, if you see last policy in August, it was a bit of a hawkish policy. It did not change the rate. It did not change the stance. In fact, it reconfirmed its stance by introducing an incremental CRR, which they call it ICRR. So 4.5% is the CRR, the money which the banks need to keep with the Reserve Bank of India, on which they don't earn any interest. On top of that, for certain quantum between July and August, the money which is incremental money, RBI imposed some 10% CRR. Now, which means taking money out of it. And then we have seen that what happened is, because of the advance tax outflow, etc., in September, the liquidity had been in deficit. I mean, one particular day it was pretty bad. It's 1.47 trillion deficit to the systemic liquidity. Now, despite that, I would like to believe that Reserve Bank of India will continue to have this policy of not allowing excess liquidity in the system, essentially the withdrawal of accommodation, which will continue, because you need to see that more money in the system is fuel for inflation. And we also need to think about the rupee. Rupee has crossed 83, per dollar. And in fact, if you have more money and inflation and rupee from every aspect, I don't think RBI can afford to let its guard down and allow excess liquidity in the system. So it will continue to be in the deficit. In that the same stance. And having said that, going forward, Reserve Bank, I will see the liquidity management will be a task for Reserve Bank of India, because festive season is coming. Then you see the elections. So typically during festive season and election, cash or so-called currency with people, currency in circulation goes up. You and me, we keep money for shopping, etc., and then elections, and another story where the cash plays a critical role in certain parts.
Given all these factors, when do you expect a rate cut now?
Well, if you see 6 months back, or even I would say that in April, May, all these people are thinking of there's the first rate cut, the end of the cycle, and the coming of a new cycle sometime in December. Then it got postponed to February. But having said that, now if you see the global situation, the way the inflation is behaving in different parts of the world, what is happening in the commodity markets, and what's happening in the oil price, and keeping in mind what's the rupee vis-a-vis dollar, all this put together, I would like to believe there would be no rate cut during the current financial year. Which how many policies we have? We have in October, then we have in December, then we have in February, then we have in April. Probably not even in April. So I would like to believe that for quite some time now, at least till April policy, unless there's a dramatic change somewhere else, everywhere, we should not think of any rate cut. The RBI at the first stage will keeping in the policy unchanged, will change his stance, and then we will see a rate cut. When that is happen, at the earliest in April, that's what I can say, but it can be even postponed beyond that.
Of course. You got us a preview into the policy. Of course, we'll find out what happens tomorrow. But as you said, inflation, the worst is over, but RBI will keep a close watch. No rate cut this financial year. Thank you so much, Tamal, for sharing all your insights with us today. We'll see you next week. It is time now for our poll results. Here's what we asked you last week. Do you expect RBI to increase interest rates? 48% of our respondents said yes, and 52% felt that no, RBI would not increase interest rates. Last week, the RBI extended the deadline for returning the 2,000 rupee note till October 7. While we still don't know what the future of this currency note is going to be after that, here's what we are asking you this week. Should RBI declare the 2,000 rupee note invalid? Our poll is open today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.